Financial Survival Network, helping you survive and thrive in the new economy. Go to carrylutz.com and sign up for 30 free micro trainings on financial survival.
This show is now brought to you by Miles Franklin. And when it comes to protecting your wealth, you know there's nothing better than gold and silver. That's what I'm buying. I hope you're doing the same. And once you make the decision to buy gold and silver, there's no better place than Miles Franklin. Look, they've been in business 22 years. And the reason I'm a customer is because when you buy, they ship. Go to milesfranklin.com or call them at 800-822-8080 to get a free quote. 1490 WGCH. This is Kerry Lutz. You're listening to the Financial Survival Network. If you're wondering if it's safe to go back outside yet and invest, well, maybe you should think hard about that one. Danielle Park's here with me of jugglingdynamite.com, and she's got some insights. Danielle, hey, welcome back for our bi-weekly get-together.
Hey, thanks, Kerry.
So what's going on with these markets? We've got Bernanke talking out of both sides of his mouth, which is nothing unusual. We've got a disconnect in stock and commodities prices. We've got a housing bubble that has burst and is getting worse and worse. What's your take on it all?
Yeah, well, the Bernanke's comments yesterday, fueled the great aspiration in the risk crowd again, just believing that he was intimating the economy is weaker than many had thought, and that likely means that the Federal Reserve is on standby for the next round of liquidity injection. And, there's a lot of speculation that if he was to announce another round of quantitative easing or intervention, he would have to do so by the April meeting, since that would be, getting to be 6 months before your upcoming election in the U.S., and that he can't do it sort of after April for fear of manipulating or being, too involved in the political process. So there's a lot of speculation that, QE2 has come to an end. LTRO in the Eurozone has the recent phase they started in the fall is coming to an end. And there's just a lot of speculation that they'll just keep doing more of the same. So based on that, yesterday you saw this big leap up in stock prices again. So now, the problem is, Kerry, as much as I would love to just, strip naked and run into the freezing water with everybody else. The problem is that, if you do any kind of math, if you take any kind of measurements, if you look at anything to do with what relative risk return rewards are built into these prices, you see that, in fact, what's happened over the last many months with all these rounds of global intervention by central bankers is that they have now managed to lower the prospective returns on pretty much every single asset class to zero now looking forward. So you have yields that have taken away, 30% of interest income has been, there's been a decline of 30% in interest income for people over the past year, for example. So the savers are getting hammered with very little income. Stocks are now priced for economic perfection that is very unlikely to arrive anytime soon. And so they have a near zero real return perspective as you look forward from these prices. Commodities have been juiced again on all this recent round of intervention, just at the time that China is now into a cyclical slowdown. So you've got things like gas, $4 a gallon in the U.S., more than $10 a gallon in Europe, Kerry. All these things are very negative for the economy, and yet at the same time, you have central bankers, basically breaking the price mechanism by their constant obsession with trying to prop up and cover over and, just help the bankers at all costs.
So it's like catching a falling knife, and it's not going to have a good outcome. And yeah, the savers, the people who are doing what they're supposed to do, because we're brought up to say, never a borrower or lender be, those people are really taking it on the chin, and therefore they have to look for more risky returns in the market. And And then we have continued currency debasement. And what I wanted to ask you was, okay, so they're not going to call it QE3, but the U.S. deficit is far too large to expect private dollars or even government dollars, especially with a surplus declining with China and other countries. Where's that money going to come from to finance the U.S. deficit if it doesn't come from QE3?
Well, this is the difficult scenario. You see that in times of crisis, money still repatriates to the biggest, most liquid bond markets in the world. We've seen this repeatedly. So into the Japanese bond market, which, flies in the face of all sort of logic to some people because they say, my God, Japan's the most over-indebted country in the world. Why would capital flow there? Because in times of crisis, liquidity, cash-like liquidity is what people need. They have to literally, get dollars to pay down margin, for example, or get dollars to, make a redemption call or to pay, a loan or something that is being called as a result of a falling asset price. And as a result, we've seen that money flows into places that are the least ugly. So the US dollar continues to be the recipient of that. Now, I'm not saying that it always will be or that there's not a lot of fiscal concern on the future, but it's always this relative choice issue. And there is a lot of captive capital in the world today, which is money that is being directed by money managers and pension funds and institutions that simply has to go somewhere. So when they look at, the relatively unattractive profile of all these asset classes, as I've described them to you, thanks to all the manipulation and intervention and nonsense that's gone on, they really have very few good choices. They're all bad choices. And so they can, sit in cash, which is painful, believe me. You don't make much sitting in cash. It looks like you're doing nothing. But on the other hand, if your choices are, go into a stock or a commodity or even further real estate at this point, all of which are still in these declining trends, nothing looks like a good return next to negative. And so I think you'd be surprised at how much more appetite capital will continue to show for things like, treasury bonds, corporate bonds, U.S. dollars, the yen, the Swiss franc. There's just a few of these available in the marketplace, and that's basically what everyone's left using or trying to take shelter in.
So it's the best-looking horse in the glue factory, pretty much, huh?
Yeah, it is. It's a tricky thing. We're all stuck on this planet we call Earth, and we've had this, viral infection that has gone worldwide in financial markets, thanks to globalization of trade and financial systems. So there is really no place that is free. And I think that the risk in the world today is probably the largest we have ever seen it in, human history in terms of risk to capital and asset values. And yet you see these bizarre trends like the volatility index, which is an indicator of concern or sentiment among traders in the world, falling below 15 recently, Carrie. So when we've seen this before, we've seen volatility, meaning people are no longer worried because they've bought into this idea that central bankers are in charge and they will keep prices elevated. You see that risk goes, actually price risk is the highest when complacency is the lowest. And that is set up year over year for the last several years for negative losses in asset prices thereafter. So you get this volatility pattern where it falls through the floor. Everybody's asleep in April. Then the second and third quarters of the year wreak havoc and horrible economic news. And it turns out the housing market hasn't turned a corner, and it goes on. And then all of a sudden you see people set up for like the chainsaw massacre, as I call it, where they were all asleep and they thought they were, at Groundhog Day and it was all good. And then it turns out to be a violent result to their life savings again. So I just think we seem to be stuck in this seasonal pattern. And, I wish you could just say, oh, well, then let's just trade with the seasonal pattern. Let's just go long risk in late, in October, November each year and sell it in April. The problem is that as soon as you just adopt that as your sole grounds for investing, it will very likely turn around and harm you. So I wish it was simple. It's quite complicated.
That's for sure. It's kind of like living on the San Andreas, having your house built on the San Andreas earthquake fault in California. And it's been pretty calm for the past 100 years, so we should be okay. We should make it another 10, but yet that quake could come at any time and just level everything, within miles of the fault. And that's what we're kind of like sitting on now, this earthquake fault. And we see these gas prices, we're pretty close to $5 a gallon in the States. Like you said, $10 in Europe and even higher in other places. And it doesn't look like there's any place for those prices to go but up, does it?
Well, except until the trend goes the other way, and then it drops with breathtaking speed. We've seen this in the last two market cycles where the fact of the matter is that oil should not be trading where it is, but for geopolitical speculation and unfettered trading, frankly, within levered markets and commodities. So if you're looking at a pure demand basis, we know Americans have been using less gas now for the past several years. They're using less than they did in 2007 today. They're figuring out ways to just save and conserve. And at the same time, China is in, as I said, a significant slowdown. They are no longer going to be pumping up their GDP with this massive injection into their infrastructure spending at the pace we've seen over the past few years. So the demand for fuel is certainly falling off. So this goes back to when we allow these, what let's call the monetary forces, to impact prices, it always circles around to harm the real economy, which then starts into this downward spiral of contraction and lower demand. And that will inevitably eventually bring prices back down in line with demand. But the question is, how long and how much pain do they inflict as they go through this? And back to your idea about the San Andreas fault and the 100-year, earthquake, lest people sort of take that as oh my goodness, you can't, that's a very long-term concern. I think this is a more immediate matter because during a secular bear market like we've been in since 2000, and like every other secular bear period that we've lived through for the last 200 years, we know that, in fact, recessions are a very frequently recurring animal. They are within 3 to 4 years typically of each other. So it is not even good enough to say, oh, well, someday these trends will have to mean revert and it'll be ugly, but we don't think it'll happen for years and years. Well, that simply doesn't stack up with the evidence. When you look at the cycles within these periods where you get some expansion and then disappointment and extreme contraction, usually for a year and a half, before you get into another period of expansion. So this is why I wish you could go to sleep and just say, oh, well, it won't happen for years to come, this contraction or debasement of asset values. But the reality is that it's happened now twice in the last 12 years. And all of the indicators are that we're at risk of another major leg down in that at some point in here. And the frustration for people is if they're trying to do the right thing, they're trying to be careful, they're trying to wait the thing out. You've got central bankers trying to bait everybody into harm's way to save their own bacon, to save the banks. And no one's going to bail out the individuals. No one's going to help the pension funds that are gaping with holes today because of this same reckless policy. The little people truly do not matter, Carrie. They do not matter. It's hard to believe. I had no idea that I would become this jaded or this
little cynical, perhaps
disappointed. I'm just disappointed repeatedly in the policymakers and the supposed leaders in power today because they continually make foolish, damaging, harmful choices, and the rest of us are going to be left to clean it up. And it's kind of very hard to watch go on and on.
Yeah, so it's the bankers. I mean, they're getting paid off they're getting kept afloat, even though they're zombies. And maybe in the U.S., you could make an argument that there's de facto nationalization, that when Ben Bernanke sneezes, the bankers are hospitalized for real bad pneumonia. And what do? Do you just let them fail and somehow protect the depositors? Do you break them up? Like Jim Rickards in Currency Wars said, it's too complex a system. You need to break them up into component parts, get them out of the casino aspect, because they were never supposed to be there in the first place. We learned this in the Depression, and yet here we are again. So they need to be broken up, basically, is what we're talking about, right?
Absolutely. And, we have precedent for this in other periods in history in other countries. Sweden, for example, had to do a massive bailout a number of years ago with their banking system. The difference was that they did it the right way. They said to the banks, fine, we'll help you, we'll loan you money, but you have to give us all of your equity in exchange for this assistance. If you're truly on death's door and you truly need us to backstop you, then here's the deal. You guys lose all your equity. You don't get to profit from us coming in and giving you ridiculously low loans, which reflect as if there's no risk. Meanwhile, there's incredible risk. So we just did it backwards. The whole banking system should have been penalized for their reckless management. And we should now say, you guys are terrible leaders. You don't deserve to call the shots anymore. We have to stop aiding and abetting this disaster. And yes, we have to put back in laws. You know how hard it is to watch people like Romney on the campaign trail in the U.S. right now saying things like the financial crisis was caused by excess regulation. This is an abomination to all sane things. This is the opposite of the truth. And the fact that people keep saying that is so damaging, because if we fall back asleep with the idea that trying to govern or regulate or intervene with sane rules and controls on leverage is the wrong answer, or is somehow socializing capitalism, this is nonsense. Socializing capitalism is what we've done, how we've gone in and rescued everybody. So yes, we need to break up these conglomerates that have taken over undue control over democracy, over the economy, and put them back in their little cubby holes. You want to be a bank, you're a lender. You don't get to lever up. You don't get to trade your clients' accounts and all this insanity that we've seen. And until we do, we will not break the back of this virus, and it will continue to wreak havoc on the global economy.
I have a friend. He works with a lot of banks, an attorney, unreformed, unrepentant attorney, unfortunately, but I've been working on him. And it's like I'm saying, Cliff, look, the banking disaster here, we didn't have a free banking sector. We have crony capitalism. We have banks that are given special privilege. And then I watched when I got out of law school, and I want to tell you how many years ago that was, Danielle, but there was like 700 something banks in New York State. When I look around, it feels like we're down to about 150 of them. So the government fostered them with accounting rules to make their profits look great, because they could take over other banks, gobble them up Pac-Man style, close out branches, fire people, move back offices to down south where costs were much lower, which I'm not against, but it was a whole shell game going on, I guess is what I'm saying, that these profits weren't really a result of economic benefit or growth. They were a result of government favoritism and effectively franchises granted to these what are now too big to fail banks. And that's why I think the system needs to be busted up, protect the depositors, wipe out the shareholders and the creditors, and let's start this thing over again, because we can't go on this way. The next blow up is going to take us all out.
Yeah, and who's left to pay who? Like, who's now going to bail out the governments who are, prolapse? Who will bail out the central bankers? It's just nonsense. It can't continue. And you're right. I remember even, when I was very young, how there was much more competition in the banking sector. And I remember vividly in the 80s and early 90s how the rallying cry in the banking sector was, we can't compete globally unless you allow us to take down some of of these Chinese walls to take down some of these divisions between our operations. We simply have to amalgamate and grow. Sure. Well, we are all paying the price and continue to do so. And, again, I would love to get to the recovery part. Good Lord, I would love to get back to rational math, looking at the earnings of a company, not on shenanigans on financial engineering, but actual products and management and growth prospects. That would all be wonderful. But right now, the publicly traded markets are so contaminated that it's extremely difficult to do a job on the investing side. Now, if you want to speculate, there's lots of people doing that and doing it on margin. As I said, it's at a near all-time high again. So there's lots of levered players still wailing away. But, for those that don't want to go bust, that makes it a much more difficult proposition.
Yeah, well, the too big to fails, they can lever up 100 to 1 or more, and they know they're going to get a bailout. And there's a movie, I don't know if you caught it, Too Big to Fail, with William Hurt. And, they're trying to paint Paulson, Henry Paulson, former Secretary of the Treasury under Bush 43, as a compassionate kind of character, when in reality, he just paid off his former employers by taking out Lehman, by making this stand that, we're not going to have moral hazard. Well, yeah, okay, so you're not going to have moral hazard. Nationalize the thing. Don't just let the one half of all these trillions of dollars of CDSs rather, collapse and leave the rest of the world financial system hanging in the breach. It seems to me that it was a takeout, and it wasn't really thought through as to how it was going to benefit the the system that remained after it collapsed. And, then the guy is like almost having a heart attack because he realized that the toothpaste is out of the tube. There's no way to get it back in.
Absolutely. And I did see that movie, actually, and I thought it was good, but I did think it was incredibly kind to Mr. Paulson. Now, here's the thing. I was thinking about this in detail because, as you know, in legal study and training, and not that there's not corrupt lawyers, I'm not trying to say that there aren't, but...
No, really? Are you sure about that?
In our education in the legal system, we spend several years learning about principles of equity, fairness, due process, things that are required in a civilized society. And we learn about the evolution of those principles through our legal system, how they came to be, because cases would come before the bench and they were blatantly unfair, blatantly, one party taking advantage of another on a loophole or something. And the judges stepped up and said, on the basis of common law, we can't tolerate this. Clearly, civilization has an interest in X, Y, and Z. So we knew a lot about that just from our youth and training and work. Now, I think that a lot of the bankers that come into the system, quite honestly, have no clue, have no idea what is wrong with all these conflicts of interest. They wouldn't know an ethical principle if it bit them on the bum. And I don't think that they mean it. They're basically oblivious. I really look at people like Paulson and think he actually was a fool. He didn't understand when he went to lobby for the removal of the Glass-Steagall divisions, of which he was one of the key people that was approaching them and saying, we no longer need this antiquated rule set. I don't know if they've read anything from history. They're so full of hubris, I don't think they believe that, that's all irrelevant to them. So I think that they truly believed in what they were doing. I think you're right. I think when the SHIT hit the fan there in the fall of 2008, they were amazed at how badly suddenly it had gone. They couldn't understand what had happened. So they start praying to God, like God's going to help us with this mess. I think maybe God would have bigger things to worry about than whether bankers are over-levered. But anyways, I just think they don't have a strong moral compass to begin with, and then they don't have any training in ethics, none of which is an excuse. But, it's another explanation for how so many people in this sector could make such bad choices.
And that's a great point you raise. And I'm going to go one more issue, which I've talked about many, many a time. If a CDS, a credit default swap, is truly an insurance policy, all right, we also learned in law school that insurable interest is a requirement in order for you to take out a policy, meaning you can't go next door and insure your neighbor's house and then insure the whole family for life insurance and then get the policy and go burn the place down in the middle of the night and collect. And yet that's what the lack of ethics and the lack of fundamental knowledge of the legal system has led to, where all these hedge funds are just making bets and then doing their best to make sure that the bets pay off in their favor. So they're basically weighting the dice so they roll out in their favor. And the insurance system wasn't designed to be this way. I think when Spitzer, one of the things he was trying to do was void all of these CDSs because of the lack of an insurable interest. And we all know what happened to him. Not that there wasn't ample reason for him to depart the way that he did, but insurable interest, what happened to that concept?
Yeah, well, because it's a misnomer in the first place. It never was. Maybe in its basic inception, it started out as an insurance policy idea, but then it just simply became chips that one could lever and trade. It really had no expectation of paying out or of covering, a legitimate loss. It became another tool for them to wield with leverage and confidence and ignorance of history. And they never seem to recognize leverage is leverage no matter what way you paint it, no matter how you structure it. All these fancy products, they depend upon perfectly timed and positive outcomes. And if you can't do any back testing to look at what will happen if these bad scenarios happen, how will we pay out on these promises, and nobody even does that exercise, Carrie, never mind tries to price it, then you know that you're in a farce, that it's just been hijacked by people looking to make a quick buck, and it has nothing to do with insurance.
Yeah, and my prediction is the CDS market will go the way of the buggy whip and the phonograph record, and pretty soon the CD, and it'll be gone because people will realize in the next disaster, the next crisis, and it's unfolding now in Europe, that they provide absolutely no protection and won't be paid off, with putting aside counterparty risk and anything else. The CD market is gone. The CDS market, it is gone. Danielle, thanks for checking in with us today. I know you're about to go to Vancouver and give an address shortly. Where do we find you again on the internet?
Jugglingdynamite.com, Carrie.
All right, and I think we have a link to that site in our resource tab on carrielutz.com. And we'll talk to you in a couple of weeks, and good luck with the address.
Okay, good luck to you too. Thanks.